In addition to being a wonderful advisor, Chris also is an author. He wrote the book Choose FI, Your Blueprint to Financial Independence. And he is also the primary author of a very popular blog called Can I Retire Yet? So he has a lot of knowledge in that brain, and he is going to use it today to talk about the three fund portfolio. So, Chris, take it away.
So let's just start with talking about traditional investment advice versus the Abundo way. So with traditional assumptions, you'll hear that, investing is complex, but you can outperform, you can beat the market. But this is hard and it's going to be complex, so you need an expert to help you. And because of that, it's going to be expensive, but you just ignore the cost because having that expert is worth it because you're going to beat the market. The Abundo way, what we're going to share with you is that that's virtually impossible, and we're going to share research that shows that. So your goal is actually just to capture the market's returns, which for the vast majority of people, if you have a appropriate savings rate, is going to get you to where your goal is, where you need to go. And because we're trying to capture the market's return, we want to minimize all investment expenses and taxes because that's going to allow you to keep more of your returns. And then you can just focus your energy on more impactful things, whether that's figuring out how to increase your income or how to budget so you know where your money is going and you can spend more intentionally, or maybe just not thinking about money at all and just, exercising or spending time with your spouse and your family or whatever is important to you. So let's just start with the idea of why do we say you should just buy the market and accept market returns? This is some pretty compelling research that actually just came out recently from Arizona State. And it showed that over the past century, only 4% of stocks accounted for all of the wealth created by the stock market, while the remaining 96% of stocks collectively matched 1 month T-bills. So what's that mean? It means like basically it would have, matched inflation for 96% of the market, while the other four gave you all of the gain. So the average stock return from 1926 to present, and this number is pretty astounding, 22,840%, if you had just the average returns. But if you had the median return, meaning you took the worst stock and the second worst and you lined them up to the best stock, and you just picked the one in the middle, the median stock lost 7.4% over that time. So what that tells us is that very few stocks basically produce all of the return of the stock market. And so we don't want to miss a few of those that are going to provide all that return. And the only way to guarantee you won't miss out on those stocks is to own the whole market. And this is kind of counterintuitive when you look at this because you think, man, with so few winners, it's got to be easy to find those and pick those. But research, and again, we're going to dive into this a little bit as we go through the presentation. Research shows that it is very hard to pick winners, and you're going to spend a lot of money trying, and those expenses that you're going to generate and the taxes trying to trade in and out are going to really eat into any returns you may build. And so it's just a losing strategy, whereas owning the whole market is a winning strategy. And so that kind of takes me to a favorite quote, and I'll throw in a couple of John Bogle quotes because I just love them. He's the Vanguard founder and a big proponent of this approach of a broad index fund approach to investing. And what he would say is, don't look for the needle in the haystack, just buy the haystack. And that's exactly what we're doing with the three fund portfolio.